Hello everybody, this is Opeyemi. Welcome to my free forex trading online course. The last time we talked about the engulfing pattern. We talked about the bullish engulfing pattern, and we also talk about the bearish engulfing pattern. Now today we are looking at the Doji candlestick pattern, the dragonfly Doji pattern, Gravestone Doji pattern, the morning star, and the evening star. If in case you are new to this channel, make sure you subscribe, hit the like button and subscribe to this channel, and also hit the notification bell so that when I post the next video you'll get the notification. Now let's get started. Now few weeks ago we started the candlestick pattern. I told you the power of candlestick pattern. See, I said the candlestick patterns, they are the language. They are the language of charting. They tell us what has happened and what is likely to happen in the market. So in every place there is a language. In every country there is a language. So in forex trading, in charting, there is language, and one of it is this candlestick pattern. They tell us something, and if you don't learn about it, you won't know. When I started forex trading, I didn't know it. I didn't know the meaning of the candlestick. I didn't know. I was just practicing blindly until I learned about candlestick pattern. So with candlestick pattern, you can predict where the price will go next. So the next one is the Doji candlestick pattern. The Doji candlestick pattern. Doji is one of the most important Japanese candlestick patterns. When this candlestick forms, it tells us that the market opens and closes at the same price, which means that there is equality and indecision between buyers and sellers. There is no one in control of the market. Now, Doji. When we say Doji, it means indecision. It means the buyers try to push the price up, while the sellers also try to push the price down. So there was indecision. The buyers, maybe they tried a little bit, pushed it up, but the sellers, they pushed it down. So when we talk about Doji, the opening price and the closing price are the same. You know, and when I started talking about candlestick pattern, we talk about the opening price and the closing price. For a bullish candlestick, the opening price is down while the closing price is up. For a bearish candlestick, the opening price is up while the closing price is down. But in the case of a Doji candlestick, the opening price and the closing price, they are the same. Look at this. Can you see it? Look at the opening price. Look at the closing price. Look at the highest price. Look at the lowest price. That's the shadow. You know, I told you about shadow. Shadow is where price went to, but didn't close there. See, price got here, But it didn't stop there. It went down. Now, let me explain something. Price opened here. It opened here. Then it went down, got to this place. But it didn't stop there. It went up again. It went up again. Got to this. It got here. But it didn't close there. Then it went down here and closed here. It closed at the same spot it opened. That's what we call Doji. Doji candlesticks. So once you see a Doji, it signifies indecision. That means the buyers and sellers couldn't take control. So price closed where it opened. That's the meaning of a Doji candlestick. As you can see, the opening price is the same as the closing price. This signal means that the market didn't decide which direction we take. When this pattern occurs in an uptrend or a downtrend, it indicates that the market is likely to reverse. See another example below to learn more. Look at this. Look at this. Look at this chart. See, I see the price was going up. It was going up. It got here. After getting up there, a Doji candlestick formed. You can see the Doji candlestick in this box. Then what happened? A reversal took place and price started falling. It started falling. So that is what a Doji candlestick can do. It can signal a reversal. That is if it happens in a support or a resistance zone, especially a major zone, support or resistance. Like in this case now, in this case, this is a resistance area, the resistance zone. So that's why the reversal took place, went down. Now, the chart above shows how the market changed direction after the formation of the Doji candlestick. The market was trending up. That means that buyers were in control of the market. The formation of the Doji candlestick indicates that buyers are unable to keep price higher and sellers push prices back to the opening price. This is a clear indication that a trend reversal is likely to happen. And as you can see in that chart I showed you, can see the trend actually reversed and went down. Now remember always that a Doji indicates equality and indecision in the market. You will often find it during periods of resting after big moves, higher or lower. There after there has been a move, maybe price was going up, kept going up, kept going up, then suddenly a doji appears at a resistance zone. And what do you see? The next price starts dropping, or reversal is the case. Let's say price was going down, price kept going down. Then suddenly a doji appears at a support level. Then price starts going up again. When it is found at the bottom or at the top of a trend, it is considered as a sign that a pure trend is losing its strength. So if you are already riding that trend, it's time to take profit. It can also be used as an entry signal if it is combined with other technical analysis tools. So you can combine other technical analysis tools to confirm, so that you not just rely on only the candlestick pattern, because it can fail. Nothing is 100% in Forex trading. Anything can happen. Now, we have different types of doji. One of them is the dragonfly doji pattern. The dragonfly doji pattern. The dragonfly doji pattern is a bullish candlestick pattern which is formed when the open price and close are the same or about the same price. When the opening price and closing price are the same or about the same price. What characterizes the dragonfly is the long lower tail that shows the resistance of buyers and their attempt to push the market up. Now look at this example. You see, dragonfly. And see the way it looks like. See the closing price. The closing price. The opening price. And look at the long tail. And see it now. So it is called the dragonfly. Dragonfly. So it looks as if it is flying. That's why they call it dragonfly. You see, it has a long tail. Once this happens, what does this mean? It means price open here. It means price open here. It went down. After getting down here, it didn't stop there. Then it went up again. Went up again and closed where it stopped. I mean where it opened before. It opened. It closes where it opened before. But it has a long tail. That's why we call it dragonfly. So we call it dragon doji bullish candlestick. Now, the illustration above shows us a perfect dragonfly doji. The long lower tail suggests that the forces of supply and demand are nearing a balance, and that the direction of the trend may be nearing a major turning point. See the example below. Look at this example. Look at this. After this dragonfly happened, before it happened, Price was going down, went down to this place, and suddenly a dragonfly formed. Then price started going up. That was after a dragonfly formed. And you know it must be in a support level. Must happen on a support level. So for you to take it, if it's not on a support level, just ignore it, because that will be a false signal. So that's a dragonfly. That's how dragonfly can indicate a change in reversal. Now, as I explained before, you see dragonfly. What happened in a dragonfly? The buyers, they push the price up. So without force that they use to push the price up, that means the buyers are showing strength. They showed strength. Now, in the chart above, the market was testing the previous support level that caused a strong rejection from this area. The formation of the dragonfly doji with the long lower tail shows us that there is a high buying pressure in the area. If you can identify this candlestick pattern on your chart, it will help you visually see when support and demand are located. When it occurs in a downtrend, it is interpreted as a bullish reversal signal. And see what happened. Price was going down before the dragonfly happened. Then what happens? You can see the way price flied up. Why? Because of the dragonfly which formed. The next one is the gravestone doji pattern. The gravestone. As the name indicates, it says grave. You know the way a grave looks like. Gravestone. You know the way a gravestone looks like. So the gravestone doji is a bearish version of the dragonfly doji, just like opposite. The opposite of a dragonfly doji. It is formed when the open and close are the same or about the same price. What differentiates the gravestone doji from the dragonfly doji is the long upper tail. The formation of the long upper tail is an indication that the market is testing a powerful supply or resistance area. See the example below. Look at the example. Look at the gravestone doji. Can you see it? Can you see that it looks like grave? That's why they call it gravestone. Look at it. See. It looks like grave. That's why they call it grave. So you don't need to cram the name. Now, what happened here? Price opened. Price opened here. It opened here. Then it went up, got here. But it didn't stop there. It went down again and closed here. Now, for it to go down, what happened there? It means the sellers, they pushed it down. They pushed it back down to where it started. So that means the sellers, the bears, they showed strength. So that means there's a likely reversal, because the bears, they showed a lot of strength by making sure that price went back to where it opened. Now, the image above illustrates a perfect gravestone doji. This pattern indicates that while buyers were able to push prices well above the open, later in the day, sellers overwhelmed the market, pushing the price back down. I explained that they pushed it back down and made it close where it opened. This is interpreted as a sign that bulls are losing their momentum and the market is ready for a reversal. Remember, when I say bulls, I mean the buyers, and when I say bears, I mean the sellers. So, in case you are joining me for the first time, so that's what I mean. So now let's see another illustration. Look at this. Look at this chart. Can you see the gravestone in that box? See this box. See the long tail. After the sellers, before that there was an uptrend. Price was going up, flying up, but suddenly there was a gravestone doji candlestick in a resistance area. It has to be a resistance area. How do you identify a resistance area? Later we will discuss that. It's another topic for another day. So after that happened, a gravestone candlestick formed. Then price started going down. So that is how gravestone doji can determine a reversal or can cause a reversal. Now, the chart above shows a gravestone doji at the top of an uptrend after a period of strong bullish activity. The formation of this candlestick pattern indicates that buyers are no longer in control of the market. For this pattern to be reliable, it must occur near a resistance level. Now, the next one is the morning star. Morning star. We call it the morning star. Why do we call it the morning star? Look at the pattern. You can see a bearish candle. That's a candlestick indicating that sellers are in control. This is a bearish candlestick. Then, and a small candlestick. This small candlestick can be bullish, can be bearish. Then another one, which must be a bullish candlestick. So this is what we call morning star, and it's a bullish pattern. I mean, it's a bullish or bearish candle. So this one can be a bullish or bearish candle. It doesn't matter. I mean the small candle. Then, but the third one must be a bullish candlestick. What does this mean? It means that price is likely to reverse and start going up. Now, the morning star pattern is considered as a bullish reversal pattern. It often occurs at the bottom of a downtrend, and it consists of 3 candlesticks. The first candlestick is bearish, which indicates that sellers are still in charge of the market. The second candle is a small one, which represents that sellers are in control, but they don't push the market much lower. And this candle can be bullish or bearish, as I told you earlier. Then the third candle is a bullish candlestick that got up on the open and closed above the midpoint of the body of the first day. That's the first candle. It must go beyond the middle of the first candlestick. This candlestick holds a significant trend reversal signal. Look at it. You can see that the third candlestick is above the first candlestick. It may not be above, but it must go above the midpoint of the first candlestick to qualify as a morning star pattern. Now, the morning star pattern shows us how buyers took control of the market from sellers. When this pattern occurs at the bottom of downtrend near a support level, it is interpreted as a powerful trend reversal signal. What does that mean? When price was going down, then suddenly you see a morning star pattern having 3 candlesticks. First, the bearish, then second, a small candlestick, then the third one going above the midpoint or even above the first candlestick. That's a morning star pattern. Then that means a trend reversal is likely. That means price is likely to go up. Look at this. When it happened here, you can see price was initially going down. Then look at this, the box. At the morning star. The first one was bearish, a long candlestick going down. Then a doji appeared. Look at it. In this case now, a doji. That's double confirmation. And see, that's double confirmation. A small candlestick is a small candlestick and it's also a doji. Then the third one was a bullish candlestick and it goes above the midpoint of the first candlestick. So that's a morning star candlestick pattern. And you see, when that immediately that happened, price started going up. So that's it. That's an example of a morning star candlestick pattern in a chart. The chart above helps us identify the morning star pattern and how it is significant when it is formed at the bottom of a downtrend. As you can see, the pattern occurred at an obvious bearish trend. The first candle confirmed the seller's domination, and the second one produces indecision in the market. The second candle could be a doji or any other candle, but it must be small. That candle must be small. But here, the doji candle indicated that sellers are struggling to push the market lower. So the third bullish candle indicates that buyers took control from sellers and the market is likely to reverse. As you can see in that chart, price went up. See, went up after the formation of the pattern, the morning star pattern. Now, the next one is the evening star. First one is morning star. Second one is the evening star. So it's just opposite. Now, the evening star pattern is considered as a bearish reversal pattern. So it's just the opposite of the other one. That's the morning star. That usually occur at the top of an uptrend. The pattern consists of 3 candlesticks. This first candle is a bullish candle. The second candle is a small candlestick. It can be bullish or bearish, or it can be a doji or any other candlestick. The third candle is a large bearish candle. In general, the evening star pattern is a bearish version of the morning star pattern. Look at this. I see the evening star. First, there was a bullish candlestick. You see. Then the second one, a small candlestick. Can be bullish, can be bearish. Then the third one is the bearish candle. You can see that it went above, it closed above the middle point of the first candlestick. That's the only time it can qualify as an evening star candlestick pattern. If it doesn't close above the midpoint, then that means it is not an evening star candlestick pattern. So you ignore it. Now the first part of an evening star is a bullish candle. This means that bulls are still pushing the market higher. Right now, everything is going all right. The formation of the smaller body shows that buyers are still in control, but they are not as powerful as they were. I'm explaining that pattern. The third bearish candle indicates that the buyer's domination is over and a possible bearish trend reversal is likely to happen. See another chart that illustrates how the evening star could represent a significant trend reversal signal. Look at this chart. And see the evening star. Firstly, price was going up. So it's going up. Then it got to a support level. An evening star pattern was formed. And see it in the box. First, a bullish candlestick. But after that bullish candlestick, price could not go up higher again. Then a small candlestick was formed. This bearish candlestick was formed. Then immediately after that, a bearish candlestick was formed. It closed below the midpoint of the first candlestick. And it didn't just close below the midpoint, it also closed higher. So that means a strong reversal is likely. And as you can see, what happened after that? Price went down. It went down. So that's the evening star pattern. In other words, the trend that created the first long bullish candlestick is losing momentum. The final candlestick gapping lower than the previous candlestick, indicating a confirmation of the reversal and the beginning of a new trend down. So that's the evening star. Let me show you a live chart on a MetaTrader 4. Let me show you something. Look at this. Can you see this? This is a live chart, but I opened it few minutes ago before I started it. So you can see it. And see this. And see the line I drew here. This is a support area. This line 1722. This is gold. So it's a major. You can see the way price kept reversing there. So look at this evening star. You can see a bearish candlestick, then a small candlestick, then price, a bullish candlestick was formed. And what happened after that? Price went up, got to this level. Look at the level it got to. This is a live chart now. See where it got to. So, assuming immediately you saw this pattern, look at it. The first candlestick, the second one, the small one, and the third one. And it happened on a support area. Look at it. The support is a major support area. Look at this. Look at this. So it's a major support area. And after it happened, price went up. It went up, got here. So imagine the number of pips you would have got if you traded this at this price, maybe at 1730. Let's say you traded, you entered immediately, the candlestick form, you enter at 1730. So price got to 1745.07. That's a lot of profit. A lot of profit. And when it got to 1745, okay, that's a topic for another day. You can see that it came down again. Why? Because it's support, it's a resistance area. So that's a topic for another day. Yeah.